Let me ask you something real quick. Why do 90% of traders lose money? Is it because they don't know technical analysis? No. Is it because they picked the wrong stocks? No. Is it because the market is rigged against them? Absolutely not. The real reason, they never learned the rules. And today I'm going to give you the 7 rules that separate the 10% who actually make money from the 90% who blow up their accounts and quit within the first year of trading. Here's what's crazy. Most people who fail at trading are not dumb. They're not lazy. Many of them are educated, hardworking, motivated people. But they sit down in front of the market without a rulebook, and the market absolutely destroys them. These aren't motivational quotes. These aren't feel-good tips you'll forget in 5 minutes. These are battle-tested principles used by professional traders on Wall Street, in hedge funds, and by self-made millionaire retail traders who built their wealth one disciplined trade at a time. If you're serious about trading, watch this video until the very end, because Rule 7 alone could save you thousands of dollars and years of painful mistakes. Stay with me. Let's get into it. Trading looks simple from the outside. Buy low, sell high, make money, right? But anyone who has actually sat in front of a live trading screen knows the truth. It is one of the most mentally, emotionally, and psychologically challenging things a human being can do. The market will test your patience when nothing moves for days. It will test your greed when a trade is going perfectly, and you want just a little more. It will test your fear when a position moves against you, and your hands are shaking over the keyboard. And if you don't have a solid set of rules to fall back on in those moments, the market will take your money. Every single time. So today we're building your rulebook from the ground up. 7 rules, 7 principles. Proven, powerful, and completely life-changing if you actually apply them. Rule number 1, and this is the absolute foundation of everything. Protect your capital above all else. Here's something most new traders don't understand when they first start out. Your trading account is not just money sitting in a brokerage. It is your ability to trade tomorrow, next week, next month, and next year. It is your ticket to stay in the game. It is your ammunition. The moment you lose your capital, the game is over. You can't trade with an empty account. You can't recover if there's nothing left to recover with. Warren Buffett said it best. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Now in trading, we can't avoid all losses. Losses are a completely normal and expected part of this business. Every single professional trader takes losses. The difference is they control how much they lose. Professional traders never risk more than 1% to 2% of their total account on any single trade. Let's make this real. If you have a $10,000 trading account, your maximum risk per trade is $100 to $200. That's it. Not $500, not $1,000. Not half your account on a hot tip you saw on social media. This sounds boring. It sounds painfully slow. A lot of beginners hear this and roll their eyes because they want to make big money fast. But here's the cold, hard truth. This one rule is what allows you to survive long enough to actually develop skill and become consistently profitable. The math doesn't lie. If you lose 50% of your account, you need a 100% gain just to get back to where you started. If you lose 75% of your account, you need a 300% gain to recover. Protect the capital first. Everything else comes after. Rule number 2. Before you enter any trade, you must define your risk to reward ratio. No exceptions. This is one of the most powerful concepts in all of trading, and yet most beginners completely ignore it. Risk to reward simply means, for every dollar you risk, how many dollars do you stand to gain? A 1.1 ratio means you risk $100 to make $100. That's barely worth it because even a slight edge in the market's favor, and you'll be grinding in place forever. The professionals aim for at least a 1.2 or ideally a 1.3 ratio. You risk $100, but your profit target is $200 or $300. That's where the real money gets made. Here's why this is so powerful and why the math should excite you. With a 1.3 risk to reward ratio, you can be wrong on 60% of your trades and still be profitable. Read that again. You can lose more trades than you win and still make money consistently. That flips everything most beginners think about trading completely upside down. Most beginners think the goal is to win as many trades as possible. Wrong. The goal is to make sure your winners are significantly bigger than your losers. Before you click buy or sell on anything, always ask yourself these 3 questions. Where is my entry? Where is my stop loss? Where is my profit target? If the numbers don't give you at least a 1.2 ratio, you skip the trade entirely and wait for a better setup. Discipline over impulse. Always. Rule number 3. This one could literally save your financial life. Use a stop loss on every single trade with absolutely no exceptions. A stop loss is a predetermined price level where you automatically exit a trade if the market moves against you. It is your safety net. It is your seatbelt. It is the single most important risk management tool available to any trader, and yet beginners skip it constantly. I know exactly what goes through a trader's mind when they consider removing their stop loss. The stock will come back. It always does. I'll just hold a little longer and wait for the bounce. This is just a temporary dip. That thinking has destroyed more trading accounts than any market crash, economic recession, or black swan event in the history of financial markets. The market does not owe you a recovery. Ever. Stocks can fall 30%, 50%, 80%, and some of them never come back at all. Companies go bankrupt. Entire sectors collapse. Currencies devalue overnight. A stop loss forces you to take a small, controlled, manageable loss instead of letting a bad trade turn into an account-ending disaster. It forces discipline when your emotions are screaming at you to hold on. Set your stop loss before you enter the trade. Before, not after. Not when it starts moving against you. Before you enter. Lock it in at a logical level based on the chart structure. And do not move it lower just because you're hoping for a bounce. That is not trading. That is hoping. And hope is not a strategy. Rule number 4. Trade with the trend and stop trying to fight the market. The trend is your friend until it ends. You've probably heard this phrase 100 times. But let's talk about what it actually means when real money is on the line. When a stock, a currency pair, a commodity, or an index is moving in a clear and sustained direction. That is a trend. An uptrend means higher highs and higher lows. A downtrend means lower highs and lower lows. And the single highest probability move you can make as a trader is to align your trades with the direction of the prevailing trend. Counter-trend trading, meaning trying to short a strong uptrend or buy into a crashing market hoping to catch the bottom, is where beginners go to lose money fast. Yes, sometimes it works, but the risk is enormous and the consistency is terrible. Think about it like swimming in the ocean. You can swim with the current and cover ground easily, or you can swim against it, exhaust yourself completely, and end up right back where you started or worse. How do you identify a trend clearly and objectively? Keep it simple. The 50-day and 200-day moving averages are among the most widely watched indicators by institutional traders, hedge funds, and retail traders worldwide. If the price is trading above the top 200-day moving average, the long-term trend is bullish. Look for buying opportunities. If price is below the 200-day moving average, the trend is bearish. Be very cautious about buying. Don't chase breakouts impulsively. Wait for the market to pull back within the trend. Find a solid level of support or resistance, and enter with a clear plan. Patience combined with trend alignment creates high probability setups that professionals use every single day. Rule number 5. Master your emotions. This is the rule that nobody wants to talk about, and it is without question the most important rule on this entire list. Fear and greed. These two forces destroy more trading accounts than any bad strategy, any technical error, or any market crash ever could. They are the silent killers of trading careers. Let's talk about fear first. Fear makes you exit a winning trade way too early because you're terrified of giving back your profits. Fear makes you freeze when a perfect setup appears because you're afraid of losing. Fear makes you revenge trade after a loss, doubling down recklessly just to try to make the money back immediately. Now greed makes you hold a winning position way too long until it reverses completely and you give everything back. Greed makes you over-leverage your account, putting on position sizes that are far too large for your account. Greed makes you move your profit target higher and higher mid-trade because you think this is the one that finally makes you rich. Both fear and greed work exactly the same way at their core. They hijack your rational thinking and force you to make impulsive, emotional, undisciplined decisions that go completely against your trading plan. Here is the reality. Trading is a performance discipline, just like professional sports, surgery, or piloting an aircraft. And just like elite performers in those fields, elite traders spend serious time and energy developing their mental game. How do you actually do this? Journal every single trade, without exception. Write down your entry, your exit, your reasoning, and most importantly, what you are feeling in that moment. Over weeks and months, you will start to see your exact emotional patterns clearly. You will know exactly when fear or greed tends to hijack you. Take breaks after losses. Step completely away from the screen. Do not touch the platform for at least a few hours. Come back only when your mind is calm and clear. Reduce your position size significantly during a losing streak. Smaller size means dramatically less emotional pressure, and that means better decision making. And above all else, follow your trading plan no matter what your gut is telling you in the heat of the moment. Your plan was made when you were calm, rational, and objective. Trust it. Rule number 6. Plan the trade, then trade the plan. These are not just words. This is the professional mindset in its purest form. Amateur traders make decisions in real time, in the moment, reacting to every candle, every news headline, every spike and dip on the chart. They see a stock moving fast, feel the excitement rising in their chest, and they jump in with no clear plan, no stop, no target, nothing but a feeling. Professional traders are different. They do the majority of their work before the market even opens. They analyze the night before. They identify their setups in advance. They write down their exact entry conditions, their stop-loss levels, their profit targets, and their position sizes. By the time the opening bell rings, all the hard thinking's already done. A proper trade plan answers every critical question before you enter. What asset am I trading and why? What specific condition must be met before I enter the trade? Where exactly is my stop loss? Where is my profit target? What is my position size based on my risk rules? Is there any major news or economic data that could affect this trade today? Under what conditions will I exit the trade early before hitting my stop or target? When you have answers to all of those questions written down in advance, you remove emotion from the execution completely. There are no surprises. There is no panic. You are simply following a plan that calm, rational you created before the chaos of live market trading began. Write your trade plan down every single day, in a notebook, in a journal, in a spreadsheet, in a notes app. Format doesn't matter, the act of writing it does. Traders who plan consistently and follow through outperform traders who wing it. The data is clear. The plan is your edge. Rule number 7. The rule that separates traders who grow into professionals from traders who spin their wheels for years and never improve. Review every trade. Learn from every outcome. Evolve constantly and never stop growing. Here is a truth that most people in the trading community never fully accept. The market is always changing. Volatility expands and contracts. Trends appear and disappear. Correlations shift. What worked perfectly 6 months ago may not work the same way today. The traders who build long-term, sustainable success are the ones who recognize this and adapt continuously. After every single trading week, block out time to go back through all of your trades. Every single one. Look at your winners. Ask yourself why they worked. Was it the setup, the timing, the market conditions? Look at your losers. Ask yourself honestly, did I follow my rules? Did I let fear or greed push me into a bad decision? Was my entry timing off? Did I miss something in my analysis? Your trading journal is your single most powerful tool for growth. Not a fancy trading system, not an expensive course, not a hot stock tip. Your journal. Because your journal shows you exactly who you are as a trader. It shows your patterns, your blind spots, your strengths, and your weaknesses in cold hard data. The greatest traders who have ever existed, from Paul Tudor Jones to Ray Dalio to Stan Druckenmiller, every single one of them speaks about the importance of continuous learning, deep self-reflection, and relentless improvement. They don't just trade more. They study themselves as traders. They examine their behavior, their process, and their results with brutal honesty. You are your biggest edge in this game. Your discipline, your mindset, your process, your ability to learn and adapt faster than the average trader. But you are also your biggest obstacle, your fear, your greed, your impatience. your ego. Work on both sides of that equation every single week, and you will grow faster than you ever imagined possible. Let's bring it all together with a final recap. Rule 1. Protect your capital. It is your lifeline and your ability to keep playing the game. Rule 2. Always define your risk to reward before entering any trade. Aim for 1.2 or better. Rule 3. Use a stop loss on every single trade, with no exceptions whatsoever. Rule 4. Trade with the trend. Stop fighting the market and start working with it. Rule 5. Master your emotions. Fear and greed are your two greatest enemies in this business. Rule 6. Plan the trade and trade the plan. Do the work before the market opens. Rule 7. Review, learn, and evolve. Never stop growing as a trader and as a person. These 7 rules will not make you rich overnight. Nothing will. Anyone who promises you that is lying to your face. But these rules will keep you in the game long enough, protect your capital well enough, and sharpen your skills deeply enough that consistent profitability becomes not just possible, but inevitable. The traders who win long-term are not the most talented, they are the most disciplined. They are the ones who respect these rules every single day, even when it's hard, especially when it's hard. If this video gave you real value today, hit the like button right now. It genuinely helps this channel reach more traders who need this information. Subscribe if you're not already part of this community, because every single week, we go deep on trading strategy, trading psychology, and real-world market education, designed to make you a sharper, smarter, more profitable trader. Drop a comment below and tell me which of these 7 rules you struggle with the most right now. I read every comment, and I respond to as many as I can. Until next time, trade smart, stay disciplined, protect your capital. See you in the next one.